Here's a figure that should stop any energy investor in their tracks. Whilst natural gas futures traders have been riding one of the most volatile commodity markets of the past decade, equity holders in LNG producers quietly walked away with returns approaching 17% this year alone. That's not a projection, that's what actually happened. And today, on July 14, 2026, with global gas markets still reeling from a series of major supply shocks, the gap between futures trading and producer equity is only widening. The question isn't whether LNG demand is growing, it clearly is. The real question is whether you are positioned correctly to benefit from it. Three events have fundamentally reshaped global LNG markets in recent months. First, the so-called Hormuz shock, the disruption to gas flows through the Strait of Hormuz, sent buyers scrambling for alternative supply routes and long-term contracts almost overnight. Second, QatarEnergy, one of the world's largest LNG producers, temporarily halted production, tightening an already constrained market. And third, as reported just 2 weeks ago, a top LNG producer began withholding shipments originally destined for Italy, creating a localized supply crunch across southern Europe. Together, these three shocks achieved what years of energy transition forecasts could not. They forced buyers to lock in supply at premium prices, which flows directly into producer revenues. Natural gas futures are essentially a zero-sum game. For every trader who profits on a price spike, another absorbs the loss. And in markets this volatile, the roll costs, margin calls, and bid-ask spreads eat into returns faster than most retail investors realize. Compare that to holding equity in an LNG producer. When demand surges and spot prices climb, producers see that revenue growth flow straight to their bottom line. No roll costs. No daily margin exposure. Just a business that sells more gas at higher prices. The nearly 17% return figure reflects precisely this dynamic, producers capturing structural demand growth whilst futures traders battle over daily price swings that often cancel each other out. The standout performers have been US-listed natural gas producers with significant LNG export exposure. EOG Resources, which highlighted robust LNG demand in its first quarter 2026 earnings call, is one example of a producer directly aligned with this structural growth trend. More broadly, companies with contracted LNG volumes, particularly those supplying Asian and European buyers locked into multi-year agreements, are insulated from day-to-day futures volatility whilst still capturing the upside of elevated demand. The Hormuz disruption has made long-term contracted supply more valuable than it has been in years, as buyers now prioritize security of supply over chasing short-term spot market savings. Analysts tracking the Italian shipment dispute expect market disruption to persist for several months, meaning elevated LNG prices are unlikely to reverse quickly. The Hormuz situation continues to inject uncertainty into global routing decisions, and new liquefaction capacity will not come online fast enough to meaningfully ease the market tightness before year-end. For investors, that means the structural case for LNG producer equities remains intact through the remainder of 2026. Demand isn't a forecast here, it is a current reality, already reflected in the long-term contracts being signed and the cargo ships being rerouted as we speak. If today's 17% producer return hasn't convinced you to rethink how you access the natural gas trade, consider this: the most durable gains in commodity markets rarely come from correctly predicting the next daily price move. They come from owning the businesses that supply the world regardless of where the price lands tomorrow. Right now, with Hormuz disrupted, Qatar constrained, and European buyers scrambling for contracted supply, LNG producers are exactly that asset. Stop trading the futures. Start owning the producers.